Markets on Friday recovered 50% of the huge losses that markets saw on Thursday. The Nifty ending about 2.5% higher. Mid caps and small caps recovered as well, 4% and 5% respectively. But even after the close we had on Friday, for the week, Friday to Friday, we were deep down in the red, 3% losses as far as frontline indices are concerned. So it's been a very, very volatile week. What happens next is the big question, and that is essentially what we try and answer here on this show. You're with us on a fresh new edition of Taking Stock. I'm Prashant Nair, and with me over the next 30 minutes, my colleague, Nigel D'Souza. Nigel, hi.
Well, hi, Prashant. Well, before we get to all the market action, here's what we have lined up for you on the show today. For a technical check, we'll be joined by Jay Bala of CashTheChaos.com. And on the fundamental side of things, well, Harsha Upadhyay, the CIO Equity, Kotak Mutual Fund, will be joining in. In corporate voices, well, we have Abhijit Roy, MD and CEO of Berger Paints. We have Mr. Sheshadri, the MD of Butterfly Gandhimathi team. Also on the show, we'll be hearing in from Mr. M.K. Surana, CMD of HPCL. But that's not all. In market opinion, we'll be joined by, we get you views coming in from Aditya Suresh, the head research and strategy at Macquarie, Dean Kim of William O'Neill, and also we'll be getting in Atul Suri, CEO of Marathon Trends PMS. It's a packed show, and here's how the market did fare in the past week itself. Well, Mangalam, I think, is stopping by to fill us in, to take us through all that went through in the past week. Mangalam?
Well, it wasn't a week for the weak-hearted. There was war, volatility, and a fair amount of weakness in our markets. All the indices actually ended lower. And in that, the biggest loser, the PSU Bank Index, down almost 6% usually happens in a risk-off scenario. And the outperformer was the Pharmaceutical Index, which actually fell by just around 2.5%. But the Nifty Bank, mid-cap and small-cap indices down anywhere between 3 to 5%. If you take a look at the Nifty stocks as well, we had nearly 47 Nifty stocks, which ended this week in the red as compared to last week. BPCL, UPL, Grasim down almost 10%. We had big declines for a couple of these life insurers as well, HDFC and SBI Life. Among the gainers that we had, just around 4 stocks, so 46 Nifty stocks actually ending lower. Hindalco, Power Grid just about a smidge in the green, while Kotak Mahindra and Cipla were also in the green by about 1.5% each. In terms of losers in the F&O space as well, we had a fair amount of them losing in double digits. India Bulls Housing, Indus Towers, for instance, lost almost 15 and 19%. Indus Towers, there was that big block deal as well. Dalmia Bharat Rain Industries and Z2 were among the double-digit losers. In terms of gainers, we had just one double-digit gainer, and that was Dixon Tech. Most of the gains on that too coming by on Friday. But importantly, Crompton Consumer also, after that deal with Butterfly Gandhimathi, saw a gain of 7% this week. United Spirits, Abbott were the other couple of stocks that managed to hold on in the green in an otherwise sea of red. So in a sense, it was a week which was not for the weak-hearted.
Well, that's right. Not a week for the weak-hearted. Thanks so much for that, Mangalam. That's about the past week. But there are big cues that are lined up for March 2022. I say that because, yes, we have the political, geopolitical scenario that will play out between Russia, Ukraine, what's going on in Europe. So near term, that's the trigger. But otherwise, big cues lined up as well. Domestically, well, we'll be keeping an eye out on the state elections. That'll come in on March 10th. Then in the middle of March, we will be hearing from the Fed. And will they go the distance? Will it be 50 basis points or not? Well, that's something that we'll be tracking out there. The continuous spike in crude prices and commodity prices as well could be hurting the margins of various users as well. So that's another trigger. The FI flows, they've deserted us for the last couple of weeks. So will they make a bit of a comeback? March normally hasn't been a great month in terms of liquidity. Inflation data coming in from, domestically as well as from the globe is what we'll track. And hopefully at the end of the fiscal year, there could be some bit of NAV propping. That's what will move around some of those stocks as well. So March is going to be a big month. Plenty of cues, both on the domestic as well as on the global front. Prashant?
I mean, big stuff, right, Nigel? And we're coming off a very big week as well.
That's true.
Just very briefly, just to add to what you said, this uncertainty about what's going to happen with regards to Russia and Ukraine is largely kind of been lifted, right? I mean, we now know what is happening broadly. This is now escalated to a military kind of a situation. There are sanctions which have been imposed, and in markets they always say that certainty over uncertainty at any given point in time. So I mean, I think in that sense, perhaps it's already in the price, right? A lot of it is already in the price. But I think a simple way to think about whether what happens from here is to ask a question: are markets and conditions for companies, businesses better off now as compared to a week back, 2 weeks back? And I think the answer is clearly no. And the reason is what you alluded to as well, which is commodity prices across the board are a lot higher. And I'm not just talking about oil. Oil, of course, is the most important channel, in terms of this geopolitical unrest we are seeing for global macro markets. And I think the longer it stays higher, it essentially chips away at global demand, etc. So I think, that's essentially what you want to see, whether we see a climb back down in energy prices more than anything else, or that also stays higher for longer. If it's the latter, and I think then conditions become a little more difficult, a little more uncertain. Even having said all of that, I think the fact is, again, as you pointed out, we are now, in a way, sort of with geopolitics in the backseat. Hopefully, you're looking at what was the primary driver for bulk of this year before, geopolitics took over, which is interest rates and what happens, what the Fed does in the US, etc., and of course the local state elections as well. So, it's a event-heavy kind of a month which is lined up in front of us the next couple of weeks, and we'll just have to take it as it comes. Let's bring in a technical expert to talk us through what he's making of things. As they say, the price shows you everything, right? Jay Bala of cashthechaos.com is with us to take us through what he's making of it. Jay, great to have you back on the show. Appreciate your time. I remember, it's been a while since we spoke, but I remember the last we spoke, you've been advising caution for a long time. With the correction we've seen, where does it leave us, according to you?
Yeah, thanks for having me on the show, Prashant. Whatever is happening, it has to be viewed from the global context. If you look at the US indices, they have clocked a series of lower lows and lower highs, and they've come down in 5 steps. This is a confirmation of what I've been projecting, that 2022 is going to be a year of sharp bull market correction. So that is actually taking shape, and it's more or less cemented in place. And so the reason why I'm talking about this, if you look at the European indices, we have a double top on the DAX and a head and shoulder top on the French CAC. So what is happening for the Indian markets is occurring in this context. So it needs to be understood with this in the background. So as I've been saying, from October, people should be long on the market with 50% cash. And then in November, I said we should go to 25%, as the maximum investment level it should keep. So the market, I think, for the medium term is heading to 14K. But, Nathan Rothschild always said, buy at the sound of the cannons and sell at the sound of the bugle. So the cannons have been sounded yesterday. So that's going to be a short-term bump up for the market. And the markets have come to important support close to 16,150 on the Nifty. And so, you could see a short-term bounce, but this is nowhere near done in the medium term. So people who have preserved cash will have a beautiful opportunity shaping up over the next 2 quarters.
All right, Jay, if we're going to be moving lower, if that's going to be the case, then who's going to take us lower? What will Reliance Industries do? For example, if you could tell us what the Nifty Bank would do, because that's really been the big outperformer. How does that one move?
Exactly.
Go ahead.
Yeah. See, the last few weeks, the banking index has been relatively stable compared to the Nifty. And that's predominantly due to SBI and 1 or 2 names in the private sector, and even AU Bank and things like that. So that is actually probably coming to an end, because HDFC Bank broke below 1420, which is a very significant level for me. And ICICI is barely holding about key support at about 699. So if once these go on a closing basis, I think there is more drag to come for the banking index. And the outperformance that we saw in the last few weeks, that's going to disappear shortly. But don't preempt the market. The resistance for the banking index is about 36,900. I suspect this market is going to take out the weak shorts and then bounce now and then turn lower.
Is there what else is tradable according to you? Both on the long side and the short side. I know you have views on the auto space, IT space. What is tradable, one way or the other? High conviction trades.
Yeah, for coming weeks, I have two short calls. You can short Cummins with a stop about 1,005 and expect 850. And Titan is a conditional short. You have to wait for the stock to break below 2350 and then only look for a short. The stop is about 2550 and look for 2100. If we look at long objectives, the mining space seems to be having some traction and it seems to be looking positive. If you look at Coal India, that's a good opportunity. But given the overall trend of the market is so trending down, you should not be on the long side on an investment basis. You should be on long side on a trader basis. So you should be looking at something like 2 days to 2 weeks time frame, not beyond that. So don't wear your investment hat yet, wear a trader's hat. And from a medium term perspective, IT is going to correct to about 27K, and then it's going to resume its longer term bull trend. But autos, if you look at autos, 10,500 is a very critical support. It has outperformed the last 2 weeks. As long as the index stays above 10,500, it's a little bit safe. But if 10,500 were to break, we're going to see acceleration downwards for the auto sector. But once again, the longer term trend is up. But you have to wait for the medium to short term correction to play out.
Okay, all right, Jay. Thanks so much for stopping by. We have taken note of all your views, and you've got it pretty much bang on for the last few months. So we look forward to chatting up with you in the coming weeks as well and get a fresh update whether or not we're cracking down or in fact we're forming some bit of a base. But let's move on then. The Russia-Ukraine crisis has sent prices of commodities soaring to new highs. Well, Manisha Gupta is standing by to fill us in with all of that. Manisha?
It has been a very volatile week for various asset classes, including commodities, but the Russia-Ukraine conflict took the commodity prices to multi-year highs. We were already trading in backwardation for many of those commodities, meaning that they are more expensive right now than what they are in next 6 months or even 1 year for that matter. And that backwardation actually got even more steepest, the most in 15 years actually. A report also from Citi indicates that the investment in commodities has been the highest since 2007. So that's the kind of money flows that you have seen coming in for commodities. Starting with crude oil prices and a 7-year highs and a $105 per barrel is what we saw being achieved for the Brent crude prices. It still is trading on the higher side of the range there. The other major commodity was gas, where we have seen 10 to 20% of a move come in on a daily basis. We are closing the week nearly 40% on the higher side for this one as well. The other commodity to keep an eye has been aluminum. We've seen an all-time highs on this one, and it breached above $3,480 per ton as well. Within the metal space, we've seen 10-year highs for nickel, and then it was the gold prices also nudging an 18-month highs in this week itself. For the agri commodities as well, this week has been of utmost importance, what with Russia and Ukraine together being major players for various global agri commodities also. So you have a 9-year highs on wheat and soybean, and sharp surges in case of potash, diamonds, sunflower, barley. Those are some of the other commodities that are looking at multi-year highs because of the Ukraine and Russia conflict.
Manisha, thanks very much for that. And that is the number one thing to watch. What happens to prices of commodities from an impact perspective, all of this. We'll take a very quick break here. We are back. Harsha Upadhyay, Chief Investment Officer at Kotak Mutual Fund, on the other side.
Welcome back. Well, to understand how do you approach this market in the near term, and which of the stocks as well as the sectors are looking good, we have Harsha Upadhyay, who the CIO equity at Kotak Mutual Fund, who joins in. Hi Harsha, thanks so much for joining in. Well, we thought that the Omicron didn't have such a big impact and life was returning back to normal, particularly for the financial markets as well. Suddenly out of nowhere you have a geopolitical risk that's on the table. Now, past reading suggests that these are the best times to start building a portfolio. Do you concur with that, or do you believe that this time around it could be a little bit different?
Good evening, Nigel. See, clearly no war is good news. So
Yes.
to that extent, market will remain volatile until the conflict is kind of comes to a halt. But the market seems to be taking a little bit of comfort as what we saw today in terms of the moves is the fact that none of the global majors apart from Ukraine and Russia are involved in this conflict. While there are sanctions imposed on Russia by various countries of the world, it is limited to Ukraine and Russia in terms of the military conflict. While we still do not know the actual impact of these sanctions and how it plays out in terms of disruption in the financial markets, etc., but there seems to be a relief rally. What we know for sure is Ukraine-Russia, while it dominated market moves during this week, it's only a sideshow. The real question is about how global central banks are going to look at interest rate scenarios going forward. I think that's the dominating theme for 2022. And if you remember a week earlier, everyone was focused on inflation and interest rates. And our belief is once Ukraine-Russia conflict is out of the way, you will again get back to the same concerns. So to that extent, I think 2022 as compared to past 2 years is going to be more choppy. And also one will have to moderate return expectations as compared to previous 2 years.
Harsha, you're calling for tougher conditions to prevail, basically, right? If somebody's managed to create some cash early on, the sense I'm getting is you're saying, well, bide your time, you will continue to get opportunities through the course of the year. Is that what you're saying? So go in a graded fashion?
Yes, Prashant. I think at least for some time the markets will have volatility, and to that extent, one may use, if at all one is sitting on cash, to deploy at lower levels gradually. I think that will be a good strategy. We still are positive on the earnings upcycle. We do believe that corporate earnings in India will grow at reasonable rates for the next couple of years. So to that extent, market will give you reasonable returns over the next couple of years, but the volatility will be much higher as compared to what we have witnessed in 2021, for example. And that's where if you're a little cautious and you're deploying at lower levels, then you will be able to manage that volatility better.
But Harsha, the problem is that suddenly commodity prices, inflation, risk, they are back on the table. And that's what's going to hurt, the earnings of a lot of companies, be it some of those paint makers, maybe, a couple of these building products divisions as well, which otherwise the street was quite bullish on. Your take on how to approach these stocks now? Suppose they correct, say, at a 5-10% odd, because I think you as well have been positive on some of these themes. Will you look to get in?
You're right, Nigel. I think if you look at September and December quarter earnings for Indian corporates, by and large, two issues have been concerns for most of investors. One is on the demand. Obviously, demand was impacted because of COVID. Now, as we go forward, hopefully, if there are no more disruptions from COVID, the demand should normalize itself. The second concern, as witnessed in September and December quarter results, have been on the margin trajectory. And that's where, because of the higher inflation in commodities, most of the Indian manufacturers have seen a compression in margins. And as we see today, the commodity prices have further gone up during January and February. So to that extent, even Q4 is likely to have margin impact. All in all, we are unlikely to see any earnings upgrades during March quarter is what we think. And that's been the trend in the last two quarters as well. So to that extent, at these higher valuation, there seems to be no support from earnings upgrades at this point of time. That's also one of the reasons why market is likely to be more choppy. Unlike in 2021, where you had uniform moves across stocks and sectors, pretty much everything moved up during that period. But from here on, our belief is it will be driven by earnings growth. And wherever you have steadiness in earnings or less disappointments, those pockets will continue to trade at reasonable multiples or move up higher. But wherever you see disappointments, the stock price declines could be larger than what everyone is used to in the recent few quarters.
All right, Harsha, it's always good hearing your thoughts. Thanks so much for joining in fact, giving us your quick view. Look forward to chatting up with you soon. Well, let's focus on some other news then. Bharti Airtel, well, they've entered into an agreement to buy 4.7% stake in Indus Star from Vodafone. Reema Tendulkar is with us to run us through all of those details. Reema?
Thanks so much for that. So Bharti Airtel has entered into an agreement with Vodafone PLC, which is the UK operator and the parent company of Vodafone Idea, to acquire its 4.7% stake in Indus. This deal is conditional upon that the money which has been raised by Vodafone PLC from the stake sale will be ploughed back into Vodafone Idea as fresh equity, and it will be used to clear Vodafone Idea's outstanding dues with Indus Towers. Now, in a way, it comes on expected lines, because earlier this week, if you remember, Indus Towers had done a block deal of 2.4. There was a block deal of 2.4% stake in Indus Towers, where Vodafone PLC had sold its stake. And at that time, in the press release, they had indicated that Vodafone PLC is also in talks with one of the large shareholders of Indus Towers to further sell another 4.7% stake. So anyway, the media and investor community was speculating that that buyer would be Bharti Airtel, and that news gets confirmed. Now, why is Bharti Airtel doing that? Now, according to the press release, what they're saying is that 5G is coming, and 5G will require a strong tower player, which is why it makes sense for them to come in, step up, and make sure that Indus Towers remains strong. This will help them become a majority shareholder in Indus Towers. Now, currently, I think Bharti Airtel has about a 47% stake. So once they acquire this 4.7% stake, they will be a more than 50% stakeholder in Indus Towers. So it gets consolidated as well. And that said, they continue to maintain that Indus Towers is an asset which they're open to monetizing at a future date also. Back to you.
All right, a couple of things to watch out for when we come back on Monday morning. Rima, thank you very much for joining us with that explanation. Well, that also gets us to a close on this edition of Taking Stock. From Nigel, me, everyone on the team, thank you very much for staying with us. More programming continues in just a bit.